This conference will now be recorded.
Hello, everybody. This is Steven Scott, and I'm the managing partner of Retirement Solution Group. I'm reaching out to you today as our second in our coronavirus market volatility updates. If you're receiving this means that in all likelihood, you're one of the 11,000 people that we support in a variety of ways, mostly as 401k participants, some profit sharing, some cash balance, defined benefit, and some in more individual managed accounts. But one way or another, you're an investor and you're going through this extremely difficult time. And obviously the point of these messages is to make sure it's clear that you're not doing it alone. I did do one of these about 10 days ago on March the 9th. And I think the part that I find most surprising, having been through numerous downturns in the past, in a 25-year professional career in the qualified plan business, is I'm really shocked that we're doing another one so quickly. But I think it's prudent because this is unprecedented on how quickly things have been happening. When we left the last message on the 9th, I don't think anybody expected the world to change as much as it did in the last 10 days. The spreading has been obvious, and the impact, as we're now all experiencing social distancing, is significant. What's also happened is that the markets have started to predict the economic effect of all this, and it's created massive volatility. On the second bullet point, one thing I really want to make clear here is this is the fastest market sell-off that we've ever seen in the United States history. And I'm a big believer to tell you that when people say this time it's different, it's usually a good idea to turn the channel or turn the page. Because usually when people are saying that, they're trying to be sensational. But in this case, it's now a statistical fact. We've never gone from a market peak to a bear market like this quickly in less than a month. That is unprecedented. So as we wanted to talk today, the biggest thing, of course, is to make sure we're enforcing don't panic. The longest bull market in the United States history is officially over. We are in a bear market, and that's really changed a lot of things and created a lot of uncertainty. And there's a lot of emotions, both for everybody's own safety and health, to their families, and then now when we're looking at our monies, as things in Wall Street have gotten a little crazy. But don't panic is really the big message that we're really trying to get across here. Some folks have been reaching out this past week and expressing frustration as the markets seem to be ignoring some of the more significant actions that have been taken. For example, Sunday night, the Federal Reserve dropping interest rates down to below zero, not below zero, basically at zero rates, and the market opening at substantial losses on Monday morning. I think you need to understand that a lot of the things that we're going to do and that the governments are going to do and various stimulus-driven programs will help different levels of this recovery. For example, I think what the Fed did on Sunday night will be impactful, but not now. What the market wants now is some degree of clarity. They want a time frame. They want a vaccine. They want something that says there's an end in sight. There's a return to people going back to work and for the consumer to start spending regularly again. And until they get that, everything else is going to be a bit of window dressing. But at some point, we will get that. And when we do, we think that companies are going to be struggling through what we anticipate is going to be a really challenging second quarter. But the fact that money will be more readily available and it'll be available at incredibly low rates, that actually might save a lot of jobs. That might save layoffs. So just because something isn't moving the market this week doesn't mean it's unimpactful. But there is a lot that's changed in the past 10 days. So as we go to bring this message to you folks, the real theme, as I alluded to in the last slide, is to not panic. But we also need to be realistic. This continues to spread and spread at a global rate and in a way that has really gotten the attention of the world. I think for the least foreseeable future, and again, I'm recording this on Thursday, March 19th, we envision that there's going to be a lot of headlines in the coming days of new all-time highs of massive spreading of this, partially because there were no tests. I say that because I myself got sick last week and wasn't sure what I had, but I really checked the box on most of the symptoms. I have a wife and kids, and had was going to be around some other people and wanted to make sure I didn't make anybody else sick. So I asked if I could be tested, and they were told, nope, too young, too relatively healthy, no tests for you. So I think that's what's been happening to a lot of people these past few weeks. So now that we're getting more tests, we're going to get a lot more data. And that data is going to also create headlines, and those headlines are going to create more and more market volatility. Doesn't mean it's all going to be down. I think volatility is exactly what it is. It's going to be massive swings. Hopefully, what we see in the not too distant future is some evidence of it slowing down. We have already seen some of that in China. We've seen increases in the recovery rate substantially. We've seen ongoing cases starting to decline, new cases declining. And so this would be one level of clarity that the markets are looking for. Now, again, we don't know when this is going to happen, but the fact that we are at least seeing evidence in some other countries, South Korea as well, that's promising. How we handle it here is going to be impactful. But one thing I want to make clear to everybody is this did feel a little different, and what substantially felt different was how quick it happened. And as I mentioned already once, this is the fastest we've ever gone from February 19th, where we hit our all-time high, to being into a bear market. And with that, there's been new headlines and changes to the way we live on an almost daily basis. Now, I think you can learn a lot from history. I've always been a bit of a history buff. And for every single person who's listening to this, you can really read this a lot of different ways. You can just take it as an FYI of these are the 10 largest bear markets in the United States history. They'll have different time periods, different amounts of that they've lost and went down. But I want you to spend a little extra time focusing on the duration, how long they were down. Because that brings us back to me what is the most important key point of this whole thing, which is what was the time horizon on your money? At RSG, we focus on supporting people in the qualified plan and retirement plan space. So as a result, almost all of our money by definition is long-term. Now, we do have some folks who are at or near retirement, sure. But even then, usually the money from a cash flow perspective is still being anticipated being used over decades. When we look at the losses that we're all experiencing right now, it's really important to put into perspective. Most people aren't looking to touch this money for years. I'm 40, God knows, I'm not young anymore, but I still have almost 20 years before I intend to use this money. So if we stop for a second, we look at the duration during these historic Great Depression, Great Recession, Black Monday, historic downturns, what you'll see is that many of the cuts are actually shorter than your brain may tell you. And that's, again, because the markets tend to focus on the future. The economy is the here and now. And so when the market starts to see improvement, it may move back quicker than we all feel it in our daily lives. So it goes down quick, and it can also come up quick. But again, I leave you all with looking at these durations. The longest one out there is post-World War II at 37 months. How many of you were really looking to use a substantial percentage of these assets in the next few years? Now, one of the reasons why many of the participants who have spoken to us over these past few weeks have been somewhat corrected in a positive way, and I want to make no mistake here. I'm not trying to suggest that people aren't dealing with incredibly challenging times and incredibly challenging markets. But many people have seen headlines, saw that the markets are now down over 30%, call us up, see that their account's down, and then we got to stop and run the numbers and say, wait a minute, bonds have done their job. For most of you who are in a diversified portfolio, a chunk of your money actually hasn't been down. And yeah, it's still been going all over the place, but functionally, bonds' core job of being a safety net in times of significant volatility, they've been doing a pretty good job of it. And as a result, what that means is the diversified portfolio is back to actually meaning something. For much of these past 10 years, and you cannot forget, we've been in the longest bull market before we got here ever in the U.S. history, 10 years we've been without a bear market. That's a long time. So many of us for years said we know one was coming. We know a bear market's coming. We know some sort of a recession is coming. But now it's here. And again, it's here for scary reasons because of health concerns. And the way it happened and the speed at which it happened is definitely scary. But if you are in a diversified portfolio, you're typically nowhere near down to the levels that the media is implying. In this particular case from a few days ago, you see negative 12.7. This, again, takes a while to get through compliance. So maybe it's today more like negative 17, negative 18. Not good, but also not negative 32, 35. As I said, the markets are always forward-thinking, forward-looking, trying to predict what's coming. And that's why they've been going down so bad, because the one thing we all know, the amount of social distancing that we have, with the amount of restaurants, bars that are closed, travel coming to a stop, we know Q2 is going to be awful. Economic data is going to look brutal. Unemployment is going to be skyrocketing up. But I do think it's important to keep in mind that while there is a clear uptick in economists believing that we're going into a recession, we're still not even at 50%. One of the reasons is that we came from a historically low unemployment rate. I mean, if you want to put a silver lining on this whole thing, it's that we weren't already at a 7% rate. We were at only 3.5. So 2.7 would be a massive increase up, but it would still just get us slightly above historical averages. So I'm not really sure if we're going to have a negative GDP number in Q1. Again, the first 2 months of the quarter were pretty normal, actually pretty good. The third month of the quarter, March, is going to be awful. We almost are insured a negative GDP number for Q2. And then the real question becomes, what's the duration of this thing? How long does it last? Do we see the bounce back recovery in Q3 where everybody starts going back to work? Everybody starts to get to a more normalized lifestyle. And if anything, we call it the damming effect, where the dam breaks and finally everybody's allowed out and everybody is jonesing to spend money and go out to bars and go out to restaurants. And of course, therefore, the hiring and everything happens accordingly. Nobody knows. But there is an argument that this technically doesn't even become a recession, because you need to have 2 consecutive quarters to technically be in a recession. But make no mistake, I myself, just the way this feels like a recession today. What we do know is that when the market goes down 20% or more, we're officially in a bear market. And there's some things we can take from that. Historically, we know that on average, the market's up about 8% in the year that follows. Okay, and many of those events happened as bear market happened, and what you saw were historically terrible times of war, depressions, and great recessions, etc. Now, most recessions don't even go below 30% decline. Most bear markets don't go below a 30% decline. We've already exceeded that. We did yesterday. The average decline is 35%, and that includes, of course, the massive impact of the Great Depression. And the median is more around 31. That 31 to 35 is what we were looking at for when we were going to start rebalancing some of our managed accounts. And that happened yesterday, Wednesday, March the 18th. And that's when we started to rebalance, meaning if you historically were at a strategy that was about 60% stocks and 40% bonds, what you'll see if you look at your account today is you're going to be more like 50 or 55% bonds. And the reason is your stocks are so depressed that the bonds are a bigger percentage of the portfolio. So by rebalancing, and again, on the managed accounts, we started doing some of this yesterday because we hit those average decline numbers. You're conceptually selling off some of your winners, which right now are your fixed income, and buying back the stocks at an incredibly discounted rate with the idea that it's fair. It may take a few more months or a while, but eventually when this comes back up, it's going to make that recovery much more favorable. At the end of the day, historically, bear markets are a short event. And we need to make sure that we think about what that time horizon is for that money, as we alluded to earlier. Think about those durations of those other bear markets. And keep in mind that if your theory is you want to move to cash and then wait for the all clear symbol, it is very rare for that to work out. In almost every situation, the numbers tell us that people lose out when that happens. Now, you may be a statistical outlier, and I hope you are. But I cannot tell you how many people in 2008 and 2009 we talked to, we convinced them not to go to cash. And even when we were, it kept going down, and that fear and stress kept getting bigger and bigger. But eventually, on March 9th, it turned the corner. And once it started coming up, it came up fast. And a lot of people then got in late. That's the problem going to cash, is you got to get it right twice. And that's what we think very few people will do. And I had many, many people thank us after the fact for convincing them not to do that in 2008 and 2009. And then I had other people who've come to us after the fact wishing that they had listened. At the end of the day, if you're in a participant-directed account, know a couple of things. There is always a cash equivalent. In every one of our plans, we have a conservative alternative that is in a positive return right now. But that does not mean we think it's the prudent thing for you to do. So what is? Number one, and I know it's not original thought, don't panic. Stick to the plan and really, really put all your energy into what is your time horizon for this money. I don't really even care when you're going to retire. I care when you're going to have to start using this money. And if you're going to have to start using this money in the next few months, well then, if you're being impacted by this dramatically, then that means that we had the risk level. Didn't sound like it was in the right place. For most people, the answer is years, sometimes decades down the road. Think back to that duration. Usually this too shall pass. The only way that you can lose money, really lose money, is to actually do a trade. In every investment, all that matters is the purchase price and the sell price. And if you don't sell, then all you will have done is gone on a terribly unpleasant roller coaster ride down that eventually will come way, way, way back up again as it did 10 years ago. There are some tactical opportunities that are out there. I referred to the fact that we've begun on our managed accounts to do some rebalancing. That does not mean that we're going hyper aggressive into stocks, because I do still think there's a lot of risk and uncertainty. And until we get more certainty, risks are going to exist in this market. The key is, can we do some slight adjustments to get ourselves in a more favorable position? Your relationship managers at RSG are here to help you do it, and hopefully this message and this recording today gave you the idea of how you do that. But I think it's also important to keep it simple. And at the end of the day, you should be able to look at your account and say, these are my risk assets and these are my conservative assets. And conceptually, what that means is, in times like this, stocks are risky, bonds are conservative. Yes, it gets a lot more complicated than that if you want to break it down into subcategories and different sectors and weighting styles. But I think for most investors, keep it simple. How much do you have in stocks and how much do you have in bonds? And then, are those in the more higher quality areas, like large cap versus small when it comes to stocks, high yield bonds being higher risk versus core bonds? Those kinds of things would be good for you to know and make sure that you're at the appropriate level. The common mistakes and/or questions that we're getting these days, a lot of participants just ask, hey, I talked to somebody and they suggested I should stop saving because, as soon as I put it in, everything's down. Could not disagree with that anymore. What should be causing everybody a bit of stress right now, what's I think normal behavior, looking at your account that you've taken years and decades to build and seeing the numbers move so insanely. But that's your existing monies. Your new monies are not experiencing anything that's happened here this past month. All they're doing is buying in, and they're buying in at a 30+% discount. That's a great thing. And as we too get through this, and I believe we will, we've gotten through every other bear market. And as you see, the longest duration one was 37 months. As we do come through this, what we believe you'll see is the benefits of continuing savings. And if you can, even increasing. Should I go to cash? As I said, participant-directed accounts, you have the right and you have the options. The people we're talking to, we're typically trying to consider, if they really are in that scenario, being a little bit more conservative, but know that there are cash alternatives. And again, your choice. Ultimately, I think our participants are coming down to three different individuals. I jokingly refer to them as the three amigos. Most people, I'd say about half of everybody I've spoken to, is what I call the talk and hold. They just need someone to talk to who they trust, who knows this industry a little bit. And at the end of the day, most of them are finishing the call and saying, I know I'm not really supposed to do anything, am I? I should just hold tight. And they know it. They just needed to talk to us first, and that's okay. What we're here for. The second group is the folks who are starting to have a hard time sleeping at night. And if you really are having a hard time sleeping at night, or if you're like my friend Jim I spoke to a few days ago who said, if I don't do something, my wife's going to kill me or leave me. Okay, well, to Jim and to the Jims out there, then I'm going to have a conversation with you, A, to make sure you know where the cash equivalent is, and B, to really get you to consider de-risking a little instead of going 100% to cash. So if you're in a balanced strategy, going down to a moderate. If you're in an aggressive strategy, going down to a growth, so that you don't have that complete change in strategy, but we can de-risk a little. And then there's another group out there, and it's a surprisingly larger group than we expected, who really do see this as bargain shopping. That while this is a major worldwide event and it scared a lot of people, the reaction to some still feels a little excessive, and that the markets are going to come back, and they're going to come back hard. And some people believe they're going to come back, even I've heard many folks, before the end of the year. If that's the case, great opportunity to save a little bit more and or do some of those rebalancing tricks like we talked before, where maybe some small percentage of that fixed income can go into some of those equities so you can enjoy the ride back up and not only make up but profit for some of the recent volatility. Everybody, as I round out this particular update here on the coronavirus or the COVID-19 market volatility, I want to leave you with just really 3 points. Number one, for many of your firms, we've been working with you a long time. I'm very proud of how long most RSG clients stay clients, and this is by far one of the most uncomfortable times we've been through. So know that we're here. Do not hesitate to call your local relationship manager. Every one of your plans has a relationship manager assigned to it. If you're not sure who it is, you can just call 866-352-7731. And if you listen to the prompts, we have a special prompt for anyone who wants to talk about the market volatility, and you'll be connected to the first available licensed member of our team. Secondarily, really, really, really focus on that key point on the time horizon. When were you planning on using this money? And then thinking back on what the durations were on the other bear markets, and ask yourself, how much should you even care about this? Because my third and final point is there's a lot of stress out there in the world right now. And if you're not planning on using this money for the next few years, don't let this be another source of stress. Focus on your family, focus on your health and your safety, and let's all collectively focus on getting through this and back to normal. And in the meantime, anything that me, my team, and RSG can do to help you in that process, please don't hesitate to reach out to us. Again, the phone number, 866-352-7731. I hope you all have a great day. Thank you very much for your time.